Hi, Greg Williamson, founder of Canada Mortgage Direct, where we teach people how to save money and properly optimize their mortgage for their overall financial wellness. In today's video, I'm going to talk about what's going on with the economy with respect to all this chatter and discussion about Greece and to a lesser extent Portugal lately. I had to ask the same question that I'm sure many of you are thinking is, why would a small country like Greece, who I think has less than 1% of the global economy, be talked about as something that could be damaging or bringing down the rest of the global financial markets? And so when I was doing some research on the web, here's what I found. Now, remember, I'm not an economist, and I'm not if anything, I'm just somebody who is interested, do the research, and I'm going to share with you in layman's terms, because that's how I understand it too, what I think is happening. So essentially the crux of this is that Greece is on the verge or possibly defaulting. Many people will say it's not if, it's when, but if they default on their debt, many people would think, well, how can this be a bad thing? Well, here's what's gone on that I think people haven't, not many of the news have been covering, and that is that most of the Greece's debt is being held by other European countries, particularly Germany and France. The issue is that, people would say, well, if Greece goes down, well, then Germany and France, it's just like anything. If you don't pay your loans, well, they take a hit. How would that then affect the global markets? Well, that alone would probably still affect global bond markets and liquidity, meaning that money in the system and how it gets out. In fact, the 2008 recession, much of the pain that was resulted from that was liquidity crisis, where banks just weren't lending money. When money's not being put into the system, things grind to a halt, economies slow down. So why would people think, well, so what? Okay, so Germany and France take a hit on their debt. But here's where it starts to affect us, and especially us, meaning Canada, but especially the rest of the globe. The Wall Street banks, in their infinite wisdom again, and there's a whole other discussion about whether or not, how long can the United States government and Congress continue to let these bankers do these kinds of things, because the only reason why they're doing it is because there is no risk of them failing because they're too big to fail and the government will always bail us out. So let's do these crazy investment schemes where we make tons of money in the short run, give ourselves big bonuses, and then if it all hits the crapper, which it did with the subprime mortgage crisis, same thing. Again, if it all hits the crapper, well, no problem, we'll get bailed out. So here's what they're doing. There's a thing called a credit default swap, which is essentially insurance on debt. So the Wall Street banks are sitting here going, how can we get in on this? And so they go to the European banks, let's say Germany or France again, and say, tell you what, we'll insure the debt for Greece. Pay us, whatever, a reasonable amount of money for the insurance, particularly because Greece was probably a higher risk. If you're a France government or Germany, and so you say, well, this is a kind of a good deal. I can lend the money, be part of the European Union, part of my responsibility. But then if it goes bad, somebody else is going to take the fall. Somebody else is going to take the hook, which is why we're in the situation we're in. If Greece defaults, the United States are going to have to pay off a ton of credit default swaps, which will, again, freeze the money markets, freeze liquidity, and cause potentially another recession. Or in some economists' view that I've been reading, it could be as bad or worse than 2008. I'm not prepared to predict because that's just way outside of my knowledge on this. However, I think it's important to take a look at, well, what are the effects that could happen? There's really two things that are being looked at right now. Either what they call a slow, soft landing for Greece, which means essentially for us is renegotiating or refinancing the debt. And in that scenario, then France and Germany just sort of probably throw more money at the problem. And I know I'm just centering out France and Germany. A lot of other European countries are involved, but those are the main ones. And so now in that scenario, though, Wall Street doesn't have to pay the insurance on the debt because Greece doesn't default. And the other scenario is just let them default. They go bad on the loans. Wall Street has to pay off the credit default swaps, and as I said, then whatever the chips fall, they will. If you're France or Germany, which one would you do? And that's the challenge right now, because they're sitting here and going at it, well, if we throw more money at the problem, I'm not sure this is a good investment for us. Otherwise, we can just let them go down and we get all our money back. So interesting to see how this is going to play out. I thought it would be interesting for our customers and people interested in the Canadian real estate market. Well, what effect could this have on us? Well, if that either one of those scenarios starts to really gather steam, my position is that we'll probably see a further reduction, or another reduction, if you will, in fixed rate long-term mortgages. And if that also leads us to a recession or a worse slowdown, then you probably won't see any increase in short-term rates again. So here we probably have another potentially prolonged time period of low interest rates. So what's the message? I think couple. One, I would stay in a variable rate mortgage because there just continues to be no reason why fixed rates will skyrocket in the coming months. And as well, even with some minor chatter around maybe interest rate, Bank of Canada raising interest rates a quarter, half a point. Even in that scenario, if it happened, which I'm not certain that it will, but even if it did, then you're still going to be much better off than taking a fixed rate at this point in time. The second thing is that keep an eye on the real estate markets. If we have another long, prolonged time period of low interest rates, we may continue to see a ramp up in sales in real estate markets, particularly in the metro markets. Now, that has another whole other effect. Well, are we going to be bubbling? Is it going to be risky to buy real estate? As always, real estate is very local. Check out your local market conditions and everything else. And as always, speak to a professional in the real estate market and in the mortgage business. I hope this message serves you. In the meantime, shift small, live big.